What's going on, everybody? I wanted to go ahead and add a video to the 25 fatal day trading mistakes. This is a list of the top mistakes that traders make. I know them from personal experience, so I definitely recommend taking all these to heart. Sometimes when you first start out and you're new, you just don't have enough education on trading to understand that all of these things are true. I've been through these myself, so I know for a fact that every one of them is the case. Some of these things you're going to have to learn the hard way. That's just kind of how human beings are. But hopefully you can read through here and do your best to avoid these before having to learn the hard way. Number one is not having faith in yourself. If you don't have faith in yourself in anything in life, you're not going to be successful. That's the bottom line. It doesn't matter what you're doing. If you're trying to be an actor, a doctor, if you want to start a business, if you want to be a nurse, whatever it is you want to do, if you don't believe wholeheartedly that you can make it happen, it's not going to happen. You can't go in half-assed. You can't go in 50%. You have to go in 100% and truly believe that you can make it happen. If you do that, you will be successful. Number two, not studying enough before you start. You need to prepare some before you just jump in. When I started trading, I actually kind of just jumped in. I just kind of jumped in and kind of learned as I went. I didn't have a mentor. I didn't have anybody to help me. And that's why I realize now how valuable it is to have somebody who can help you avoid these traps, know what to do, what not to do, because they've been through it personally. So that's why I highly recommend getting somebody who knows what they're doing and who can help you. That's the bottom line. So, but anyway, study up before you start. Read books, watch YouTube videos, look at internet articles. There's a lot of stuff that's going to be free online. What you can't find online is a trader who has actually done it, where you can learn through watching them and seeing what they do. That is probably the best possible way to learn to be successful. And you also have to make sure it's somebody who does know what they're doing. There's a lot of baloney out there, a lot of people out there who claim to be traders who aren't really trading. They're marketing guys, they're bloggers. They love to put up videos of fancy cars, beautiful women, and houses that aren't theirs, and make the impression that they're rich. And it works. It truly works, because people assume they're successful and they should be listening to them. The problem is when it comes down to it, they're not providing any value. Look at their Twitter accounts. Is there any actual value in the tweets? Most of it's marketing. A lot of these, they claim you can get rich quick and this and that. But the truth is, day trading is tough. It's hard. It's one of the toughest jobs in the world, because you lose money and it can be highly stressful. So do not buy into all the nonsense you see online. All right? Number three, not learning from a successful trader. Kind of going back to what I was just talking about. A lot of people make the mistake of getting in with somebody who doesn't know what they're doing. They learn the wrong way. Maybe they do really trade, but they're not successful. So you're learning the strategy that's actually not profitable on a regular basis. And then you got to start over from scratch and learn all over again. Just like, you build a house, if the foundation's off, the entire house is off. And it's got to be, rebuilt from the bottom. So just be careful, Try to get with somebody who's posting real entries, real-time entries, real-time exits, like we do in my trading room. I post every entry and exit exactly when I get in at that time and exactly when I get out at that time. All right, giving up too easily. Persistence is one of the most common traits of a millionaire. That's just a fact. If you can look at anybody, and I clicked a link to, a nice article that talks about the traits millionaires possess, but persistence is number one. That's the top thing. They never give up, and they continue and continue and keep going until they get to where they want to be. There's no plan B. There is no other option. They find what they love, and they persist until they're successful. Number five, not keeping losses small. This is huge. Too many traders, they get in, and the trade's going against them, and rather than just cut it loose and take the small loss and get out, they just let it fester. They just let it continue, and the loss gets out of hand to the point where they could get into a catastrophic situation. You definitely want to avoid this. For me personally, if I start getting into a loss, it might be, it's in the $4 to $5 grand range. I start to get uncomfortable and I'm looking to exit. Sometimes, though, you do have to know when to wait it out, and when to go ahead and cut it. That takes time, that takes experience, and you'll learn as you go through mistakes and basically tuition cost. Chasing stocks too high. This is a very common trader mistake. I think I did this some in the beginning as well. You know, you see a stock that's been running up for a couple days, the chart's just going straight up. You just assume that it's going to keep continuing. But as soon as you get in and chase that thing, that's when the selling comes. That's when the shorts start to hit it, and a lot of selling takes over and it drops it. So that's why you don't want to chase high. It's better to wait for a dip and get in at cheaper. You know, you want to buy if you're going long, you want to buy low, you want to sell high. So it always makes sense to get the stock cheaper. So just wait for the dip, catch it, you know, when it gets down to some support areas, and then sell into strength. I came up with a term for this called a prawn, and I got that from the movie District 9. Prawns are these bottom-feeding aliens that were left over, basically were dropped off on Earth, were kind of all the dregs of life. And a prawn is also a shrimp. And so I kind of came up with this term prawn for anybody who chases high or, you know, buys a stock that's dropped real low, just assuming it's going to bounce back, but then it never does. It's just kind of a term for people to think about because you definitely don't want to be one. All right, next, over-leveraging positions. Don't take positions that are too big for your account. This is a huge mistake. It might even be the #1 thing that blows up people's accounts. If your account has, say, 10 grand and you're going in with 10 grand on each trade, you're just asking for disaster. And I understand that your thinking is you want to get a bigger gain by leveraging the max amount of money possible. And yeah, that's true. And you might hit a big gain, but eventually it's going to get you because you're going to get stuck in a bad situation way too heavy, and it's going to end up giving you a huge loss that you may not be able to come back from. All right. And to be honest with you, sometimes if you go in too heavy, you might get lucky, and you might get it's actually really bad to make a big gain this way because you get into a situation where you feel like it's working for you, so you keep doing it, and maybe you even get away with it for like a month. The problem is you could do that for a month and make a bunch of money, and then one time it could wipe it all out. So it's a lot smarter to go in with, say, 10 to 15% of your account, and don't borrow from brokers. Put that in. That way you're less stressed. You can make smart decisions. You have plenty of other money left to take other trades, so you don't miss those by having all your buying power being sucked up. And you won't be at risk for things like margin calls and brokers force buying you in, and then you can get restrictions and all kind of hassle. So you definitely want to avoid that. Now, I understand if you have a very small account, 2K, you're thinking, well, 15 to 20% of that is not going to really help me get any gains. So you want to be smart, and if you see a really good setup, you might go in a little heavier. If you have a $2,000 account, you might want to go in with 33%, maybe even 50% if you really like the setup, because I understand you have to get ahead. But if you have a bigger account size, you're over pattern day trader status, you're 25K and above, there's no need for it to make money. You can go in with 5K in a trade, 3K in a trade, and still make enough money to get ahead. So just keep this in mind. All right, number 8, over trading out of boredom. This is tough because when the market gets slow and the volume is weak, you start to get antsy. You want action, you want to make some money, so you start jumping into trades that really aren't that great of opportunity. They're really not that great of a setup. I've done this myself. I still get sucked into it sometimes when I'm bored. And it's, we're human. It's not easy to sit back on the sidelines and not trade, but sometimes that's the smartest thing to do is just sit on the sidelines and just wait like a sniper for the right opportunity. And if it doesn't come, be patient. Sometimes I haven't traded for a week. Sometimes I don't trade for a few days. And no, it's not fun. And believe me, I'm out to make money as fast as anybody else. But sometimes a smart play is to sit on the sidelines. Rule number 1 is don't lose your money. Don't lose your money. That's number 1 thing. Okay, because once you start losing, it takes even larger a gain to make that money back and get back ahead. All right, number 9, failing to control emotions. We're all human. We're all emotional creatures, some more than others. But emotions can tear you up when you're trading. And when you're in real heavy, that's going to increase fear. That's going to heighten the emotions. So do things like, I mean, exercise. Working as a trader, you can get obsessed with sitting at the computer and just watching the charts, and I mean, time can go so fast, and pretty soon you've been there all day, and you're not getting any exercise whatsoever. I mean, you're exercising your mind, but you get worn out mentally, and you need some physical activity. So lift some weights, play sports, get out, run sprints, jog, and do some yoga, because you really have to have your mental state has to be right, and exercise is really important for that. So please. Um, Also, pay attention to what you're eating, because I mean, I've had times where I had coffee and a Red Bull and I'm trading, and it increases your anxiety, and it can affect your decisions. It can literally affect the decisions you make when you trade. Yeah, this is a stressful job, and we don't need everybody, throwing keyboards, breaking computers. That can get costly. So try to avoid this type of thing. Not taking profits because you're greed. We're greedy by nature. I think that humans are naturally greedy. If you just look at children, when they, I want this, I want that, they don't want to share, they have to be taught. I think we are kind of naturally greedy. So we all had that in us. And I think a little bit of greed is actually a good thing, because if we weren't greedy, we wouldn't be driven to get things in life, to get places, to acquire, to make money, to get cars, to get a significant other. That all kind of comes from greed. So a little greed's good. What you don't want too much greed. Too much greed in life in general is a bad thing. You want to share with people. You want to give back to people. You don't want to be overly greedy with trading, because if you do, you will end up paying a price. But you don't lock your green. Let's say you're up a couple thousand. I've had this happen many times. I was up a couple thousand. I got a little greedy, thinking, I want to make 3 or 4. This isn't enough. The stock went against me, and that green turned into a big red, and I ended up losing money. That happens all the time. So when you're up pretty good, take the money. Take the money. Don't get greedy, because as they say on Wall Street, it's a very common phrase. They talk about it in the movie Wall Street, which is so great with Gordon Gekko, that bulls make money, bears make money, and pigs, they get slaughtered. And that's an absolute fact. Okay, number 11, not learning from your past mistakes. Some people will make mistakes in life, and they continue to make them over and over. Why this is the case, I don't know. Learn from your mistakes. If you make a mistake when you trade and it costs you, don't make that mistake again, or at least do your best not to. Make the necessary adjustments, improve, grow, evolve your strategy, and make sure your trading skills get to where they need to be. Just like you hear in life, a common phrase, practice makes perfect. That's true. With day trading, it's the same. As you work, as you trade, you become more experienced, you become better, just like anything else. Number 12, not setting limit orders. If you set market orders, you're going to be at the mercy of the market maker. And I can promise you, the market maker is not out to help you. Yeah, they make markets, they provide liquidity, but you know what? They're out to make money just like everybody else. Okay? Nowadays, most of the market makers are going to be algorithms, and these algorithms are nasty. You take a short position, and they see it. They're gonna push it up on you, try to put a little pressure, try to get you, to buy to cover higher, so they can make money. They make money. They short, they buy, and they're gonna make money by pushing it up and down. So you gotta watch this. You gotta know this. They're gonna push it up on you. They're gonna bring it back down, because that's how they make money. They make money by moving it back and forth and buying and then selling and then shorting and covering, just like we do. And if you don't set a limit order, they will take advantage. All right. An example would be if you're long and you have very negative news drops, a market maker, it's going to be tough for you to exit. So you might want to jump in with a market order in this particular case, but generally you want to have a limit order. That way you aren't taken advantage of. But if, let's say, you're in a stock and you buy it long and some really bad news comes out, chapter 11 or something like that, it's going to drop fast. So a limit order probably won't fill because nobody's buying, too many people are selling. So you might want to put in a market order in that case if you need a very quick exit. That could be important. But for the most part, you want to always use limit orders. Misunderstanding margin rules. Be sure that you're aware of all the margin requirements. There's a lot of stuff to go through, so just click this link right here, margin requirements, and go through and read all that. Make sure you understand SEC regulations. You don't want forced buy-ins, day trading calls, margin calls, and restrictions. Number 14, listening to talking heads. I'll tell you right now, most of the talking heads you hear on TV, all of them, CNBC, Bloomberg, whatever you're watching is a lot. It's all about entertainment. It's all about them trying to guess what the market's going to do. And to be honest with you, it's all a joke. It's all about it's just making money. There's no real value. I hardly ever find any kind of value. I might learn a little bit here and there. You might keep up with the news. Really, the best thing about it is keeping up with the news and what's going on in the world. That's going to help you so you understand what the market's doing, because that can affect you. If you're long a stock and there's really bad news, like for example recently this North Korea talk and all this, you want to know, you probably want to be looking more at short positions. If things are really bullish and we just came out with great jobs data, then you might want to look more for the long play. So just keep that in mind. But just be careful listening to any calls they're making on television, and watch the social media. A lot of people on social media, not everybody, there's some very good people, but a lot of them are just out to fulfill their own agendas. So you got to be careful what you listen to. Listen to your own intuition. That's usually going to be the best thing. Trading without real-time software. A lot of new traders are using Robinhood. It's a free app, and I'm not saying it's a bad app. I think it's a great app. But maybe if you're investing in some stocks, but if you're day trading, you have to be able to see level 2. You have to be able to see the bids and asks. You need real-time streaming news. You need, real-time software. You can't successfully day trade using Robinhood. You can't successfully day trade if you're trading from the website and you're getting 20-minute delays. That's just not going to work out for you. Investing, yeah, you can use Robinhood. You can buy a stock, sell it in 2 weeks. You don't have to watch the day-to-day movement and price action, so you'll be okay. But I personally use DOS Trader Pro. I like it. It's direct market access, fast entries and exits. And I also use Fidelity, I use Active Trader Pro, and I like that software a lot. Fidelity I use more for like investing and for some swing trades. There's not a lot of small cap shorting. And then DOS Trader Pro, I use that more for my shorting of smaller cap stocks, and if I need really fast entries and exits and things of that nature. There's a lot of good softwares out there. Just do a Google search and you'll find a lot of different options. Revenge trading. This is really common. You get mad sometimes. You lose on a stock and you get ticked off and you want to come back at it. You want to hit it again. You want to try to get back the money. Very rarely does this ever work. I've found that 90% of the time when you have something like this happen, you try to trade it again, you end up losing more money, becoming more frustrated. Don't revenge trade. Certain stocks, it's just not going to work out for you. An example for me was the stock PACB. My team and I in the trading room, we tried trading this thing. It just kept going up. It was grinding sideways. We tried to short it. It just didn't work. So I put it on the no short list and we got rid of that thing. I don't trade it anymore. It just didn't work out every time we tried. And I said, that's it. We're not touching this stock. Boom, it's on the no short list. No trade list, actually. We didn't buy it long or short. Not understanding news release verbiage. This is a big one. Companies purposely put out verbiage in their PRs and their news that is confusing. They want it to be confusing. They bury it in with this complicated press release, especially bio stocks. I mean, hardly anybody understands what they're saying. People that are really savvy in biotech do, but if you're not real savvy you're not going to understand how they're explaining the phase 2 results and the phase 3 results, and You have it's done on purpose, so you're confused. And if you look at earnings, you look in the 10Q, it should just have the basic things like right at the top where you could quickly, get through it and understand it. They should have expenses, what are revenues year over year, what's profit, all the important things. But instead they bury it so deep in there that you have a hard time finding it. So you have to watch the price action to get an idea of, whether it's positive or negative. Like Snap recently, when those earnings came out, it seemed real confusing the way that, and you get different press releases. Like one sounds like it's positive, one sounds like it's negative. You don't have a lot of time to look through and really understand it because the price is moving so fast. And with Snap, it dropped really quick, then it popped back up, and people didn't know if it was good or bad. Finally, once people realized that the earnings were not very good at all, and they had a huge loss, it finally came down. But this is all from misunderstanding the press release. So try it. It's hard when the price action starts moving big. You want to get sucked in to jump it on the trend, but try to be calm and patient. Make sure you read through it, give it a little time, and make sure you understand what's happening before you take a position. Number 18, not understanding financial statements. Financial statements. This kind of goes back to what I was just talking about, but the financial statements, they can be really confusing. You need to understand 10Qs. That's going to be the quarterly earnings, 10Ks, that's going to be the yearly earnings. Form 4s, I look at Form 4s a lot because they show you insiders that are acquiring stocks or getting rid of stocks. That can be a really good indicator of something to come. If some insider has taken a big position recently, they might know something, and there's a good chance the stock could be running. Also, if they've dumped a lot recently, that could be a good indication that the stock's going to drop. So look up Form 4s and understand what they mean and understand what's going on with those. Form SC13GAs, this can be an indicator that somebody's taking a big stake. And, a lot of times this information comes out too late. They took the stake 3 months ago. The stock, as soon as people find out, the stock blows up. They make a bunch of money. They sell everything to the retail traders that are chasing it. Fortunately, with day trading, company fundamentals are less important. Technicals matter more. If you're investing and you want to buy Apple long, you need to know all the ins and outs of their earnings and their situation. But with day trading, more importantly, it's going to be the news itself, the catalyst that's driving the stock, in combination with the price action, the volume, the float of the stock, and you need to look at support and resistance, and you're trading in and out on the chart. So it's less important, the company fundamentals. It just doesn't matter as much. Now, if you're going to swing for 2 or 3 weeks, you may care a little bit more. And be careful jumping in before earnings because it's a lot like a casino play. It's a lot like a crapshoot because you have no idea, unless you're an insider who knows what's coming. It's a big gamble to be in before earnings. So be careful of that. Another thing I look for is that a lot of companies that really need cash and stocks that are moving, especially things like biotechs, they're moving, and you can't explain why it's the action's so strong. A lot of times they're being pumped. There's a stock promotion pushing them up so they can do an offering. This should be illegal, shouldn't be allowed, but it happens all the time from week to week. I see it. The stocks run, it doesn't make any sense. They go up 200-300%, and then conveniently, once everybody's bought into it, the retail traders are always the ones holding the bag. They buy into it, thinking it's going to continue. Boom, here comes the offering. It was at $1 less than the stock price is currently. It drops and it crushes all the retail chasers. So be careful of that. All right, number 19, playing sideways, moving stocks. If a stock is moving sideways, it's a dangerous play. You're looking for volatility. That's king when it comes to day trading. All right. If you get in sideways, it could pop on you. It could drop on you. You get in sideways, it could, if you short it, all of a sudden it pops and boom, you're in trouble with a bad entry price. You also, same thing. You buy it long and boom, it drops on you, fails support, and you're getting hit. So look for volatility. You want to short pops. They correct on selling. You want to buy dips. They bounce back on buying to cover and dip buying. So look for the volatility. Stay away from sideways. Trading with rent and food money. If you're trading with money that you can't afford to lose, you're going to be more stressed. you're going to be more emotional, and you're going to make bad decisions. So I understand if you have a small account, you have to do what you have to do to try to get gains. But if you're doing this and you lose the money and you can't pay bills, you're in a bad situation. So you got to be careful with that for sure. It's tough growing an account at the beginning, I know, because I started with a smaller account. But that's why do whatever you can to stick money in the account. Don't just do it from the trading. You want it. The key is to get over the pattern day trader 25K. Then you can make trades in and out throughout the day, and you're not stuck with the 3 trades and the 5 business day rolling period. That's kind of a pain. So that's the key initially, is to go from the smaller account to over the 25K. And you need to get a good bit over 25K, because if you get to 25K and then lose 1,000, you're going to be under pattern day trading status again. And so that's the initial goal. So do whatever you can to stick money in it. Stick it in from tax returns. Work a side job, doing whatever, stick it in. Stick the money in to the account. Get it a little bigger. Work on the trading as well. Instead of going out and spending a lot of money on fancy things that you really can't afford to try to look like you have money, be smart. Don't have the expensive car. Don't spend the crazy money on expensive restaurants. Use that money, eat at home, and put that money into the account. Grow the account, and then once you have the money down the road, then you can do all these fancy things. Delayed gratification is what it's called, where basically you're putting off gratification now for greater gratification later by being smart. Most people don't do this. Most people, as soon as they make any money, they put it right into fancy things because they want to live the dream. They want to look like they're living the dream, and it works. People believe it. But the fact is, deep down that you can barely make these payments, and really you're stressed out every month with the bills, and you can barely take it. So keep this in mind. Number 21, not being aware of the law of attraction. I don't care who you are. I don't care if you believe this or think it's true. This is a fact. I know this from personal experience. If you look at all of the greatest people in history, they know about the law of attraction, whether they realized it or not. Okay? The law of attraction is not saying that if you just believe something, it's going to pop up in front of you. Okay? That's not what we're saying. What I'm saying is that when you think, and what thoughts you put out there is energy. And like energy finds like energy. If your mind is dominated with thinking about something you want in life, and you keep putting that thought out there, somehow, I can't explain how, it eventually will convert itself into reality. Because your thinking affects your action. So if you're making bad trades, you start getting a negative thought process, and you start thinking, oh, I can't do this. You get negative, and your action starts to change. You go in smaller. You're getting out sooner, and your thoughts actually affect your reality. Okay? You can read up on YouTube. A lot of people, Napoleon Hill, one of the best books I've ever read is Think and Grow Rich. Definitely recommend that. Read Les Brown, Tony Robbins, even people like Ray Lewis and Oprah Winfrey, they know about the law of attraction. They talk about it. You think about something, put up a picture of what you want in life. Put up a picture of the car, the house you want, maybe a significant other you want. Think about it every day. Let it dominate your thinking every single day. Think about what you want. Laser focus on that and start taking the action towards getting that, and you would be surprised what happens. Just try it. Okay. A great quote from Napoleon Hill's book is, whatever the mind can conceive and believe, it can achieve. And that is a fact. Steve Jobs, he talks about this all the time. He talked about this a lot before he passed on. But the bottom line is that just pay attention to your mindset. Pay attention to what you're saying. I can tell when I meet people by what they're saying, I can tell what's in their mind. I can tell if they're negative. I pay attention to certain words. I can tell if they're going to be successful based on how they think. Like for me, I say I will. When I get there, I will get there. I hear other people, well, I hope I get there. Maybe I'll get there. That cannot be your thought process. You have to know. You have to truly believe it. And you have to think and know that it's going to happen. You have to have that mindset. And that if you have that mindset, it will happen for you. That combined with persistence, never giving up, and just watch what happens. It'll be amazing. Okay, all right. Number 22, having a negative mindset. This is kind of similar to 21. Being negative will attract negative things into your life. It's just that simple. So pay close attention to what you're thinking. Pay close attention to what you're saying. Um, if you want something bad enough and if you're willing to go for it, the universe will give it back to you. I can't explain this power, how exactly it works, but it does work. And again, I'm not saying anything cheesy like just think about it and the genie's going to pop up and make it happen. That's not what we're saying here. It always takes work and action. But just try to pay attention to your thoughts. Keep them positive and watch what happens. You'll be amazed. You'll be amazed at changes that can happen. Uh, Number 23, trading too many stocks at once. I personally don't like to trade 4, 5, 6 different stocks. It's hard to watch them. It's hard to keep track of them. If one goes really bad against you, you start to panic a little bit, and then the other 5 are hard to watch. Keep it simple. I like to find one good opportunity, and I'll trade that over and over and over. Now, you have to be a pattern day trader in order to trade in and out over and over throughout the day. If you're under 25K, you can only do 3 trades in 5 business days, so you can't be trading in and out. You got to be a little more picky. You want to be more of a sniper and pick the best possible opportunities because you're limited on the trades. But I will pick 1 or 2 stocks and I'll go in and out all day, in and out all day. Buy, support, sell into strength. So short the peak, cover into the dip. I'll do that all day. Okay, and I can focus on one. If it starts to go bad, I'm ready to get out. I'm not distracted by other trades. This is really important. Be laser focused. All right, number 24, not utilizing stops. This is very important. I personally use mostly mental stops. If I do buy a stock long and I'm near a support area, I know that if the support fails, that the stock's going to drop on me. I'm going to take a good little beating. So I will have a stop set on a long at support. I don't usually like to set hard stops on the shorts nearing resistance because a lot of times algorithms, market makers will push it up and they like to hit the stops to push it up, and then sometimes it'll break the high a little bit, trigger the stops, then just to come back down. So depending on the situation, depending on the stock, the float size, is it a biotech or is it something else? Will depend, but sometimes I will set stops on shorts, other times I won't. But it can't hurt you to have hard stops set just in case as protection. Now, always keep in mind, if it's getting close to the high or low of the day, that's when the biggest volume is going to come in. Okay, because people are going to start buying thinking there's going to be a breakout. People are going to start shorting thinking it's going to fail. Or when a stock is dropping to the low of the day, people are going to start buying thinking it's going to bounce, and people are going to start shorting thinking it's going to crack and go lower. So that's when the biggest volume comes in. So if you have a stop set too close to support or resistance, the market makers are going to tag it. Let's say you have $2 and you have that support. Let's say you buy it. Have a stop 10 or 15 cents below. Not too close to where they're just going to dip a little bit, hit it, and make money off you. Have it about 10 to 15 cents lower. All right. 25, failing to take responsibility for your mistakes. This is really big. There's something called an externalist and an internalist. And an externalist blames everything outside for their mistakes. Oh, it was this guy's fault. I listened to Jim Cramer on CNBC. It's his fault. Everything is outside factors. That's the wrong attitude to have. The successful attitude that all the people who have done things in life have the internalist attitude. They know that they are responsible for every single decision they make. Okay? Nobody else. Nobody puts a gun to your head and says, take this trade. Okay? If you enter and you exit, if you listen to somebody else, that's on you. If you take someone else's advice, that's on you. You need to assess all the information you have and you make your decision and then you be responsible for it. Okay? And that attitude is a smarter way to go. And then when you make a mistake, which is going to happen, we all make mistakes. Learn from the mistake. Learn from that decision. And next time, be smarter. Take responsibility for your bad trades, learn from your bad trades, And the key is going to be learning from these mistakes, and you have to be resilient. You have to be able to handle loss and come back, and you have to consistently improve your game. Trading is you evolve. Okay, it takes time. Don't believe the people telling you you're going to become a millionaire in a year, or you're going to become a millionaire overnight, or all this baloney that's out there. Okay, it's hard work. It's going to take time. You can make a lot of money in trading. Trading is awesome. You can work for yourself. Nobody's telling you what to do. You can work from anywhere with a laptop computer. You can be in Dubai. You can be at the river, the lake. You can be in California. Wherever it is that you want to be, you can trade with a laptop. That's a beautiful thing. But it's going to take work like anything else. I would say 2 to 3 years of hard work to get really good at this. And you wouldn't expect to become a doctor in 2 years or 1 year or 30 days. You wouldn't expect to be a successful actor if you just work for 30 days. Everybody who's been successful in any of these endeavors has put a lot of hard work, maybe 5 to 10 years. So don't expect this is going to be easy, and don't expect this is going to happen overnight. Work hard, study, practice, and you will be successful. Be resilient and be persistent, and don't stop until you get where you want to be. That's the best advice I can give. All right, everybody. I hope this article and I hope this video has been a big help. My goal is to get people better at trading and help them to become full-time. If you have any questions, always email me, bprising1@gmail.com, and join our trading room and learn how to trade from myself and all the other people in my room. We trade successfully and profitably on a regular basis, and we love to coach and help others to do the same. Thanks. Until the next video, everybody have a good one.